In this month's economic update, Kaplan Professional Education's Victoria Papandrea speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's November Economic Update. I'm Victoria Papandrea, and today I'm speaking to A&P Capital's Chief Economist, Dr. Shane Oliver. Shane, thanks for your time today.
My pleasure, thank you.
Firstly, Shane, what impact will a slowdown in the mining boom have on the Australian economy and cash rate over the coming months and into 2013?
Well, I guess over the last couple of years we've become used to the mining sector providing a big boost to the Australian economy. In fact, the huge surge in mining investment has added maybe 1.5% to economic growth, and that's sort of squeezed other sectors of the economy, and that's been evident in softness in housing and retailing and so on. So on the one hand, as mining slows down, that's going to be bad news. We'll see the economy slow. On the other hand, the slowdown in the mining sector does provide room for the other parts of the economy to pick up pace. So my feeling is that we could go through some adjustment problems over the next year or so, which may see growth slow down to around 2.5% or thereabouts, which is in fact our forecast. But I think that as the Reserve Bank's interest rate cuts, with probably more in prospect, feeds through, then we should see a pick-up in retailing, housing, construction, manufacturing, tourism and so on. And all of those things I think should start to fill the gap left by the slowdown in the mining sector.
Can you bring us up to speed with the latest news coming out of Europe?
Well, I guess for the last couple of years we've been used to lots of action out of Europe, and of course it usually starts off with Greece blowing up yet again, and then it feeds through to the other countries and worries that Spain and Italy are going to fall over, and then maybe the same with France. And of course this year hasn't been any exception, with all of those concerns being there. And of course we've also seen the Eurozone slip back into recession, which I think was inevitable after the sort of uncertainty of the last 18 months or so. But I guess the good news is that the European banks do have a steady source of funding. Almost a year ago now, the ECB said if you want some money, can't get any money from other banks, come along to us and we'll give you cheap 3-year money. And of course that's stabilised the funding situation for European banks and therefore helped stabilise their lending. And of course more importantly, starting in July, European Central Bank President Draghi said that they will do whatever it takes to defend the euro. So the euro is not going to blow up. It's going to be here forever, according to the central bank, and they'll defend it. So consequently that, plus a subsequent detailed plan to buy bonds in countries like Spain or Italy if they apply for assistance and agree to certain conditions, then the ECB will step in and buy their bonds and help get their borrowing costs down. All of those developments I think has helped stabilise Europe. So yes, it's in recession. Yes, it's terrible if you're in Spain or Greece. It feels probably more like a depression. But at least the overall recession in Europe seems to be relatively mild, and it's probably not going to get any worse. So I think at least the actions by the European Central Bank have helped stabilise the situation in Europe. Right now, of course, still some uncertainties around regarding Greece, Spain, but that's probably going to be an ongoing factor. But I think that ECB backstop is really helping.
Shane, recent economic data suggests growth is picking up pace in the US. What's your outlook for this economy for the remainder of 2012?
Well, again, for the last couple of years now, a bit like the European problems that blow up every 6 months or so, America's gone through worries about having a double dip back into recession. We saw that in 2010, we saw it in 2011, and of course we saw it around the middle of this year, and of course US growth did slow. But the good news is that American growth seems to be sort of motoring along, very subdued pace for a country that's gone through such a deep recession as they saw back in the latter part of last decade. So the recovery remains very constrained. But the good news, I think, is that the Federal Reserve has stepped in, much like we've seen the ECB swing into action in Europe, we've seen the Federal Reserve swing into action in the US, and they've basically said that until the US labour market starts to look a lot stronger, they'll continue to pump cash into the US economy. So yes, there's risks with that, but I think at the end of the day, that's the right thing to do. The last thing we want is a rerun of the Great Depression. So that gives me a bit of comfort that America's growth will continue. You're probably looking at growth over the remainder of this year of, say, 2%, possibly a bit of a pickup as we go into year end. Housing sector looks pretty good. That's a huge positive, I think, for America, the fact that housing is looking stronger. As house prices edge up, that's going to help wealth, which also, of course, helps consumer spending, and retailing looks reasonably solid in the US. And then, of course, as we get the election out of the way and some of those issues associated with a huge fiscal cutback in the US, which I think will be cut down in size over the next few months, then I think we'll start to see business investment picking up. So we'll probably see economic growth in 2013 pick up to a pace of around 2.5%. Now, still not overly strong, but at least probably just enough to keep the unemployment rate gradually trending down.
Just finally, Shane, recent economic data has boosted confidence that Chinese economic growth is bottoming. What's your thoughts on that?
My feeling is that China is bottoming. We saw a huge slowdown in Chinese economic growth over the last couple of years. Go back to the start of 2010, growth was around 12%, or just below, 11.9% in fact. That was as a result of the stimulus that was applied through the GFC. So the Chinese economy suddenly took off again. That caused fears about inflation. The Chinese authorities tried to slow growth down. And those efforts to slow growth down in China, combined with slower global growth and therefore slower export demand, saw Chinese economic growth more recently slow down to around 7.4% on an annual basis. So that's the 12-month rate of growth. That said, if you look at the quarterly pace of growth, it's actually picked up. It's in the June quarter it was 1.8% at a quarterly rate. In the September quarter it was 2.2%. So it does look as if Chinese growth seems to have gradually started to edge up a little bit. And you get a similar picture when you look at money supply growth, when you look at rail freight shipments, for example, when you look at industrial production, when you look at investment figures, they look to be stabilising, and also retail sales. And then, of course, the final thing which has showed a bit of improvement recently in China is export growth, which has picked up in September. So all of those things, I think, are consistent with the Chinese economy probably bottoming out with growth somewhere around the 7.5% to 8% sort of range. And my feeling, therefore, was we're not going to see that much feared hard landing. And as we go into next year, we're probably looking at reasonable growth. Not the double-digit numbers we got used to, but still pretty solid growth of around that 7.5% to 8% sort of pace.
Shane, thank you so much for joining us today.
Okay, my pleasure. Thank you.
And that brings us to the end of the November PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.